Hello, everybody, and welcome to the Sense of Security podcast. Today, we welcome back James Yendrey of InvestMentor to discuss why losses hurt twice as much as gains feel good. So imagine this. Back in March 2020, as markets plunged, an investor watched his portfolio drop fast day after day. Headlines were nonstop, and he checked his phone constantly. Sounds familiar, right? So after a 30% decline, he sold everything to just make the pain stop. Weeks later, the market rebounded sharply, but he stayed in cash, waiting for clarity that never came. He missed one of the fastest recoveries in history. A month later, the market was higher. So often people say the pain of the drop made the recovery impossible to trust. So on that note, James, how are you?
I'm doing good. I think that's a very good segue into this discussion.
Awesome. I'm so glad you like it. I made it just for you. So why does losing money feel way worse than making money feels good?
One feels like a win, whereas the other one kind of feels like a mistake. Making money for everybody it's nice, but losing money, you're just scratching your head thinking, why did I do that? And then you tend to remember your losses deeper than your wins. You replay them in your head, trying to psychologically think, could you have done something different? But with wins, you move on pretty fast. You're like, okay, cool, I got it. Carry on. Let's move on to the next one. But the losses, they sting a bit more.
Yeah, I agree with that. So is this just emotion or is it hardwired into how we think?
So it's baked in. Your brain is wired to avoid pain. It's more so than the chase, really. So when you lose money, your brain treats it like there is something that needs to be fixed immediately. You feel it disproportionately more than you do on that gain. And humans, being the perfectly imperfect creatures we are, very susceptible to more emotions, especially when it's driven to things tied to a monetary value as opposed to slight wins in the marketplace.
Yeah, I think it's like in the back of your mind. You have that caveman mentality, which is like, oh, what's around the corner? Is it a lion? Like, what is it? Am I going to be attacked? What's this cascade of waterfalls of problems happening? I think that comes back to it, and you have to just say, no, that's not the case here. So in this case, let's define loss aversion. And why do losses hit approximately 2 times harder than gains?
They don't feel good. They hit a lot harder. Usually, when you're making these types of decisions, especially when it's directly correlated to money, people like to go through the path of least resistance. And so if it means to cut losses, say at a 10% when the market can contract 15 to 20%, as long as you're holding, you're not over leveraged, you're perfectly fine. But the thing is, if you're getting the red notifications on your trading applications, you start seeing these numbers, you feel that more intensely. And it's not a good feeling. And so you have people shorting really good positions that they got into, shortchanging themselves, taking whatever loss that they can to recover minuscule gains, or just outright taking the loss before it contracts further down.
So why do small losses quickly turn into panic selling?
That's a good one. You tend to hesitate after a drop. You second guess good positions where you start thinking back to it. Did I do my technical analysis right? So are the fundamentals on this particular choice accurate? When you start second guessing these good positions, you start to hold on to the bad ones because you don't want to take that loss. It's not logical by any stretch of the matter, but it is avoiding the bad feeling of pain.
How do volatility and real-time tracking, the apps we have, the alerts, make it worse? Or
You can
better?
see it.
Or
You,
better?
you can see it really happen in real time. You're getting the notifications, you're seeing the red, and it sucks, quite honestly. It sucks, especially when you're looking at it and your alarms are going off, or your stop losses have been hit, or your take profits have been hit. It's better to take a zoomed out approach to everything. Yes, even in your initial example, you had a huge contraction within the marketplace. But holistically, if you zoom out on that chart, it's a significant contraction, but it's nothing that an investor couldn't necessarily weather. Like you said, 30 to 45 days there later, they were back in the green. And so taking the downtick, and in my opinion, as the market continues to contract, these present you with more buying opportunities. However, if you're over levered, you don't necessarily have liquidity to actually purchase in it, and you're over levered to the yields, you're really going to feel those pains, and your alarm systems are going to go off, your take profits or your stop losses are going to be triggered, and you're just going to be eating loss after loss. And in these cases, zooming out and taking a more passive approach in times of volatility, as opposed to a more active approach. Yes, you can squeeze alpha out of pretty much any circumstance that you would like, right? But the fact of the matter is, if you're wanting to be more of a long-term dominant player in the market, think about being an infinite player rather than a finite player, and think long-term rather than short-term.
So going back to the story I told, why do people sell at the bottom and lock in losses?
Panic selling, it really snowballs. Again, red, and it annoys you. The drops tend to make you feel uncomfortable. Think like you're on a roller coaster and you get that dip. Some people seek that chase. You're like, oh my God, this is really cool. But at the same time, other people are throwing up right next to you. Like, it's not good. And you also don't know where the bottom is. Hindsight 2020, right? You don't know where that bottom is. Are you going to keep bleeding out? Are you going to assume worst case scenarios in every situation? Sure, you should have them mapped out, but I think Warren Buffett said it best. It's like, if you bank on the end of the world, you're only going to get it right once.
Ooh, good quote. I like that.
Whatever portfolio you decide to build is able to weather the storm, and ensure that you do your due diligence to figure out if you're over levered in a particular one. You can do back testing and benchmarking to ensure that the overall impact of the portfolio can withstand things like the .com bubble, can withstand subprime, or now we have data for a global pandemic, and then at least 5 years worth of accurate data on what happens on the recovery from a global shock like that. So you're able to benchmark and back test a little bit more accurately. If you do that, you take more of a long-term view on things. You're going to be more excited for the dips psychologically, right? You're going to see red, but now red is going to see it. You're going to flip that switch. Oh, this is a buying opportunity because I'm 10, 15% cash. So now I'm able to buy in these more opportune marketplaces, and it goes a lot further.
Why do we hold losers too long, but sell winners too early?
So why hold losers, but sell winners early? It's because selling winner feels good. It's like, next, I was right. I got the pick. I was able to get it. But selling a loser feels like admitting you messed up. And people don't like to necessarily admit that they messed up, especially when it's on your trade log, when it's on your books and you have to carry that loss. The end result, you cash out your good ideas and you keep your bad ones. And it's not necessarily a sustainable practice.
So how do you tell the difference between a temporary dip and a real problem?
The fundamental, I would say, was the price change, or did the underpinnings of that business change? They go like all birds. You're investing in an apparel company. Next thing you know, in their earnings call, they shift everything into AI. That is a radical shift. And the market deemed it as a net positive. Okay. If it were the other way around, it would have been a huge net loss for these guys. But if nothing about the company actually got worse, probably just noise. If something did change, then yeah, pay a little bit more attention to the fundamentals of the company and the investments that you actually place.
So in your experience, what simple habits or tips reduce panic?
Zooming out, we touched on that. Stop looking at daily moves. If you're an investor and you're a genuine investor as opposed to a trader, in my opinion, take out the daily minutia into it if you're investing for the long term, and look at the big picture. Oftentimes when you zoom out, the chart looks like the chart. You zoom in, you can find ebbs and flows in anything, and everything looks like it's fallen off the cliff. But a 5% contraction in NVIDIA will bring down the market. But if you zoom out a little bit, you see it's over 4,000% over the last 10 years. 5% contraction seems okay, relatively speaking. Check a little bit less. The more you look, the more you react. Like you start seeing these red flashes coming up, you feel like you need to act when it's not necessarily the case. Sometimes the best course of action is to rely on the trading strategy, the investing principles that you put, go back to the fundamentals. If nothing has changed in the underpinnings, it's just chop, it's just volatility. Take it as an opportunity to increase your position in those particular equities as opposed to selling out. And then I think lastly, it's really good to benchmark and back test. Have a plan for when things get messy, because in a moment, you won't trust yourself anyway. Like when you're in that moment of making that decision, am I panic selling or is this something else? Either way, emotionally speaking, you are becoming decoupled from your primary objectives.
Yes. So I think that's a good place to stop. Don't forget to breathe in those scenarios. And I think, like in all things, when you take a step back, it could be trading, it could be something in life, and a month goes by, 2 months go by, and you go, I had that experience, but I'm still here. I'm breathing. I'm okay. The world didn't end. Everything's all right. And so I think that's always good to keep in mind in these type of scenarios and also just in life itself. Anyway, James Yendrey of InvestMentor, thank you so much for your insights. We appreciate it. And thank you so much for joining our podcast today. And thank you, listeners.
Thank you, Mary.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice.
IBKR InvestMentor is a service of Interactive Academy LLC, an affiliate of IB LLC and majority owned by IBG LLC. All content provided by IBKR InvestMentor is for informational and educational purposes only and should not be interpreted as implying any sponsorship, partnership, endorsement, recommendation, or approval by IB LLC or its affiliates. Short selling is an advanced trading strategy involving potentially unlimited risks and must be done in a margin account. Trading on margin is only for experienced investors. With high risk tolerance, you may lose more than your initial investment. For additional information regarding margin loan rates, see ibkr.com/interest.